Five assets. Not five assets that dip, not five assets that underperform, five assets that go to absolute zero, purchasing power annihilation during an economic crash. And at least two of them are sitting in your portfolio right now. Here is what everyone gets wrong. They think a crash means stocks fall 30%, you hold tight, and everything bounces back. That is a recession. That is a bad quarter. What I am talking about is a real crash, the kind that rewrites the rules of money overnight. Argentina 2001, Greece 2010, Lebanon 2019, Weimar 1923. The kind where your bank account still shows the same number, but that number cannot buy you a sandwich. Most financial advice tells you to diversify across asset classes and ride the storm. That advice is designed for normal downturns. It will get you killed in a real collapse because certain assets do not just lose value. They become radioactive, and by the time you realize you are holding one, the exit door is welded shut. By the end of this video, you will know exactly which five assets vaporize in a genuine economic crash and the historical autopsies that prove it. Luxury durable goods. Your designer watches, your $90,000 SUV, your boat, your collection of rare sneakers sitting in a climate-controlled closet. These objects feel like wealth. They look like wealth, but in an economic crash, they become anchors that drag you to the bottom. Here is why. Luxury goods derive their value from two things: discretionary income and social signaling. Both of those evaporate the moment a genuine crisis hits. When people are scared, truly scared, they do not buy Rolexes, they buy rice. Consider Buenos Aires, December 2001, where Argentina had just defaulted on $93 billion in sovereign debt, the largest default in history at that time. The peso, which had been pegged 1-to-1 with the US dollar for a decade, collapsed overnight. Banks froze accounts. Citizens could not withdraw their own savings. The unemployment rate hit 25%. Now picture the used car market. Before the crisis, a 3-year-old BMW 5 Series in Buenos Aires held roughly 60% of its original value. Standard depreciation. Within 6 months of the crash, that same car was selling for 15 to 20 cents on the dollar, if you could find a buyer at all. And here is the knife twist. You could not sell it for pesos because nobody wanted pesos. You could not sell it for dollars because nobody had dollars. The car just sat there depreciating in the driveway, costing you insurance and taxes you could not afford, while your neighbor who owned a bakery was bartering bread for medical care. The 2008 financial crisis showed the same pattern in the United States. McKinsey Global Institute tracked consumer behavior across 15 countries during the downturn. Luxury goods spending collapsed 15 to 35% depending on the market. But here is what the aggregate data hides. The resale market cratered even harder. High-end watches lost 40 to 60% of their secondary market value within 18 months. Luxury vehicles depreciated at twice their normal rate. Boats were practically unsellable. Marina operators across Florida reported vessels being abandoned because owners could not afford the docking fees and could not find buyers at any price. The mechanism is brutal and simple. In a crash, the pool of buyers for luxury goods shrinks to almost zero. Everyone who would buy your Patek Philippe is also liquidating their Patek Philippe. Supply floods the market. Demand vanishes. And unlike gold or productive land, a luxury watch does not generate income, does not produce food, and does not hold intrinsic utility beyond telling time, which your phone does for free. During the Weimar hyperinflation, Adam Ferguson documented families selling grand pianos, fur coats, and antique furniture for a single week's worth of groceries. Objects that had been family heirlooms for generations were traded for potatoes, not because the objects had no craftsmanship or beauty, but because beauty does not feed children. This is the brutal truth about luxury durables. They are consumption disguised as investment, and in a crash, the disguise falls off. Why? Government bonds, the bedrock of conservative portfolios, the asset your retirement fund is overweight in right now. The thing your financial advisor calls the risk-free asset. Here is the problem. There is no such thing as a risk-free asset. The phrase is a marketing slogan invented by an industry that profits from your trust. A government bond is a loan you make to the state. You give the government $1,000 today, and they promise to pay you back $1,000 plus interest over 10, 20, or 30 years. Sounds safe, but the repayment comes in the government's own currency. And if that currency loses purchasing power through inflation, debasement, or outright collapse, your safe bond becomes a receipt for worthless paper. Let me show you how this plays out in practice. Greece, 2012. Greek government bonds underwent what is politely called a restructuring. In reality, it was a forced haircut. Private bondholders, pension funds, retirees, and small investors lost 53.5% of the face value of their bonds overnight. Not gradually, not over decades. A single announcement wiped out more than half their investment. Greek citizens, who had been told their entire lives that government bonds were the safest place to store wealth, watched their retirement savings get cut in half by decree. But Greece was a formal restructuring. The more common and more insidious method is the silent default. This is what happened in the United States after World War II, and what is quietly happening again right now. After 1945, U.S. debt to GDP hit 119%. The government did not default. It did not raise taxes enough to pay it down. Instead, it held interest rates below the rate of inflation for over a decade. If you bought a 10-year Treasury bond in 1945, yielding 2.5% and inflation averaged 6% per year, you lost 3.5% of your purchasing power every single year. After a decade, your safe bond had lost roughly a third of its real value. The government paid you back every cent owed. The money just could not buy what it used to. This is financial repression, and it is the default playbook for every indebted government in history. Argentina's bond collapse in 2001 destroyed $82 billion in bondholder wealth. Russia's 1998 default wiped out the country's entire domestic bond market in a single week. Venezuela's bonds became worthless as the bolivar disintegrated. In every case, the people holding safe government debt were the first casualties. Here is the pattern. Governments issue bonds to fund spending they cannot afford through taxes. When the debt becomes unsustainable, they have three options: default explicitly, restructure the debt, or inflate the currency so the debt shrinks in real terms. All three options destroy the bondholder. The only question is speed: fast and visible, or slow and invisible. Long-term bonds are especially lethal because they lock you in. If you hold a 30-year bond and inflation spikes, you are trapped. You are collecting fixed payments in a currency that buys less every month. You can sell the bond on the secondary market, but its price has already collapsed because nobody wants to buy a fixed income instrument in an inflationary environment. The risk-free asset is a trap. It is risk-free for the government. For you, it is a slow-motion wealth extraction machine. Cash, the thing in your savings account, the thing under your mattress, the thing your grandparents told you to always have plenty of. Cash is king until the kingdom falls. In a normal economy, holding cash is prudent. It gives you liquidity. It gives you optionality. But in a genuine economic crash, the kind that involves currency devaluation or hyperinflation, cash does not just underperform, it evaporates. Beirut, October 2019. The Lebanese pound had been pegged at 507 to the dollar since 1997, 22 years of apparent stability. Lebanese citizens trusted the peg. They held savings in pounds. They deposited their life earnings in Lebanese banks. Then the peg broke. By 2021, the black market rate hit $15,000 per dollar. By 2023, it crossed $89,000. A family with 150 million pounds in savings, roughly $100,000 at the old rate, now held the equivalent of $1,685, same number in the account. 98.3% of the purchasing power gone. Not invested in a bad stock, not gambled away, just sitting in a savings account doing exactly what they were told was safe. The mechanism is always the same. Cash is a claim on future purchasing power denominated in a specific currency. When that currency collapses, the claim becomes meaningless. You are holding a ticket to a show that has been canceled. During the Weimar hyperinflation, workers were paid twice daily, not because their employers were generous, but because their morning wages were worthless by afternoon. A worker who received 1 million marks at noon could not buy a loaf of bread with it by dinner time. Ferguson describes women rushing from factories to stores during lunch breaks, sprinting to convert paper into anything tangible before the next price update. Venezuela, 2018. The Bolivar lost 99.9% of its value. Citizens with lifetime savings in Bolivar-denominated accounts were financially annihilated. Federal Reserve data from the 2008 crisis shows that even in the United States, even without hyperinflation, cash savings lost purchasing power as real interest rates turned negative. The consumer who held $100,000 in a savings account from 2008 to 2015 earned barely 0.5% interest, while real inflation ate 2 to 3% per year. They lost roughly $15,000 in purchasing power, while their account balance barely moved. Cash is not wealth. Cash is a representation of wealth denominated in a unit the government controls. And when the government needs to fund deficits, fight wars, or service debt, the value of that unit is the first thing they sacrifice. Speculative growth stocks, not all equities. Let me be precise. Productive equities, companies with real revenue, real exports, real assets, can survive and even thrive during a crash. But there is a category of stock that gets absolutely slaughtered. And it is the category that dominated portfolios from 2020 to 2022. Speculative growth stocks, companies with no earnings, no dividends, no tangible assets, and business models that depend entirely on cheap capital and optimistic projections. These stocks do not just fall during a crash, they go to zero. During the 2008 financial crisis, BLS data shows that over 400 publicly traded companies in the United States went bankrupt. Not 400 small obscure firms, but major names. Washington Mutual, the largest bank failure in U.S. history. Lehman Brothers, $691 billion in assets gone. General Motors required a government bailout to avoid total liquidation. Shareholders in all three were wiped out completely. But 2008 was a credit crisis. In a currency crisis, the destruction is even more targeted. During Argentina's 2001 collapse, the Buenos Aires Stock Exchange lost over 60% of its value in dollar terms within months. Companies that had been darlings of emerging market investors, telecoms, tech startups, consumer brands, saw their stock prices collapse, not because their businesses failed, but because their revenue was denominated in a currency that no longer functioned. The Greek stock market fell 92% from its 2007 peak to its 2012 trough, 92%. An investor who held 100,000 euros in Greek equities in 2007 had $8,000 left 5 years later, and those were the survivors. Dozens of Greek companies were delisted entirely, their shares worth literally nothing. Here is the mechanism. Speculative stocks are valued on future earnings that do not yet exist. In a crash, the discount rate explodes, meaning the present value of those hypothetical future earnings collapses. Simultaneously, access to cheap capital disappears. Companies that were burning cash while waiting to become profitable suddenly cannot raise their next round of funding. They die. The lesson from every crisis economy, Greece, Argentina, Venezuela, even Japan's lost decades, is identical. Companies without real earnings, real cash flow, and real productive capacity are the first to be destroyed. They are castles built on clouds. When the weather changes, there is nothing underneath. Leveraged real estate, not real estate itself. Real estate, productive, unencumbered, in a stable jurisdiction, can be an extraordinary store of value. But leveraged real estate, property purchased with heavy debt in a market experiencing economic collapse, is a wealth destruction machine. Here is why. When you buy a house with a mortgage, you do not own the house. The bank owns the house. You own the equity, the difference between the property's market value and what you owe. In a normal market, that equity grows as you pay down the loan and as property values appreciate. But in a crash, both of those mechanisms reverse simultaneously. Property values fall, your equity shrinks, but your mortgage payment does not. You owe the bank the same amount regardless of what the house is worth. If the property drops below what you owe, you are underwater. Owing more than you own, your asset has negative value. In the United States, 2008 to 2012, home prices fell an average of 33% nationally. In some markets like Las Vegas, Phoenix, or parts of Florida, The decline exceeded 60%. Over 10 million Americans found themselves underwater on their mortgages. Between 2007 and 2010, approximately 3.8 million foreclosure filings were processed. Families who had been told their home was their greatest investment watched it become their greatest liability. But here is the detail that consumer spending data from the Bureau of Labor Statistics reveals. It was not just the loss of the house, it was the cascade. Underwater homeowners could not sell without bringing cash to the closing table. Cash they did not have. They could not refinance because the collateral was worth less than the loan. They were trapped making payments on a depreciating asset while their income shrank because the economy was contracting. Many stopped paying entirely, destroying their credit scores for a decade. In Greece, property values fell 45% between 2008 and 2017. Property tax revenue collapsed, so the government raised property taxes to compensate, squeezing owners who were already losing money on their investments. Citizens who had leveraged up to buy apartments in Athens found themselves paying higher taxes on properties worth half what they paid, with tenants who could not afford rent in a collapsing economy. Spain's crisis was even more vicious. Between 2007 and 2013, Spanish property prices fell 37%. Over 500,000 families lost their homes to foreclosure. Under Spanish law at the time, losing your home did not eliminate the debt. You still owed the bank the difference. People were homeless and in debt for properties they no longer possessed. The mechanism is leverage. Leverage amplifies gains on the way up and amplifies destruction on the way down. A 20% decline in a property you bought with 10% down does not mean you lost 20%. It means you lost 200% of your equity. You are not just broke, you are in the negative. Productive, debt-free land, especially agricultural land, has survived every economic collapse in recorded history. But leveraged residential or commercial property in a crashing market has destroyed more middle-class wealth than almost any other asset class in modern history. So let us lay this out. 5 assets that lose everything in a real crash. 1. Luxury durable goods. Consumption masquerading as investment with no buyers when fear hits. 2. Long-term government bonds in domestic currency. The risk-free asset that gets sacrificed first when the state needs to survive. 3. Cash and cash equivalent savings. A ticket to a show the government can cancel anytime. 4. Speculative growth stocks with no earnings. Castles on clouds first to fall, last to recover, if they recover at all. 5. Leveraged real estate. The middle-class wealth destroyer that turns your greatest asset into your greatest liability the moment the market turns. Every one of these assets feels safe during good times. That is the trap. Safety is a function of environment, not of the asset itself. A life jacket is safety equipment on a boat. It is dead weight in a desert. Now here is what nobody is telling you. We are not in normal times. Global debt has crossed $315 trillion. The U.S. alone carries over $38 trillion. Interest payments on that debt now exceed military spending. The warning signs that preceded every crash we discussed tonight, from Argentina to Greece to Lebanon, are flashing in economies that people assume are untouchable. The next video breaks down the 5 assets that have survived every crash since 1923 and the exact allocation framework the survivors used. If you are holding any of the 5 assets we just discussed without a counterbalance, you need to watch that next. If this story changed how you think about your portfolio and the hidden dangers in your garden of investments, please subscribe and like the channel. We are performing financial autopsies to unearth the history they tried to bury. Let us plant the seeds for a more secure future. The next treasury of insights will be open soon.